All right, all right, all right. The alarms are going off, Johnny. We are back. We're back on Monday.
Yeah. I'm
Yeah,
impressed
let's
that you've
get
got an
on
alarm
there.
for it. No, I didn't realize that you were so organized. So kudos
Two
to you.
seconds before. 2 seconds before. I like to get my shit
Oh,
going on here. Ooh, excuse me. Excuse me. I'm gonna clean
Ma-
it up here. Clean
MacGyver
it up just a
style.
little bit.
Flip the red
Guys,
wire.
yeah,
Yeah.
I still love that show. He was the best, right? It's like he would be in the most critical situations and he's like, get me a straw, a pineapple, and a donut. And he would just get out of it.
I think that's a different show.
But you know what
But
I'm
yeah,
saying,
it's
though?
certainly something like that. Yes.
Something
I
like
think
that.
there's more duct tape involved with MacGyver than donuts and pineapples.
And
But
electrical
still,
wires. Yeah.
yeah. It's all about ingenuity.
Ah, good times back then in those days. Guys, we're just messing around a little bit just to get going. Want to get in the groove here, but we are back. It is Monday. We got Macro Monday coming right at you guys. That is John. Walk up over there. I am Noah Rosenblatt. We are both with UrbanDigs, okay? And for those of you that are new to the show, we're going to start out with Manhattan real estate. I got it all up right there. I can see it right there. Talk about where we're at, where we're supposed to be. Fall season is in play, Johnny. And then we're going to go to some macro stuff, talk about a couple of things, and then we'll circle back to Manhattan and we'll try to do all of this in 30 minutes or less. None of this stuff is financial advice, so don't start trading it.
It's not. And yes, and I do want to mention that I would love. So obviously we have the comments. So you can if you type in the comments, we can see it. So if you ask questions, fantastic. If you want to get a conversation going, really cool too.
Yeah,
I would love.
don't be shy.
Don't be shy. Don't be shy.
No,
I would
let's
love
talk.
suggestions. Like if there's any things you think we could be also talking about, or you want us to talk about longer, please feel free to throw it in. We're always working on trying to make this show better, to give you guys the information that you need to deal with clients and to get deals done. That is why.
Yeah. Let us know what you want to hear. Maybe you want us to bring someone else on this show. You don't want to hear me and John talk all the time, right?
Certainly.
Or Noah, shut the hell up. Let
I
John
would
talk more.
welcome that.
Yeah, I hear that. Absolutely. We're all down for people. Let's get to it. Let's mess around here. Let's get to it. All right. So, guys, I'm looking at the market snapshot here on the UrbanDigs dashboard. I click 1 month Manhattan ticker, guys. Supply 30 days, 1767. September, of course, is our biggest new listing month of the calendar year. October's a little lower than that. We're supposed to have 1525 in October. So what you're seeing here is the process. There's still stuff coming on, going up week to week, but that's probably going to go down as October progresses, Johnny. So we're a little above, but that's normal.
Okay? Yeah, it's very, very front loaded, right? So October, you're going to see that supply come on, and it's going to start fading quickly as you get to the back half of October. Certainly November, it just starts going down. And really, you don't have a meaningful rebound until you get to like January, mainly February.
Yeah, exactly. So keep an eye on that. We came in hot in September. We had around 2,000 listings or so. So we'll see whether or not we come in hot again in October. Listings definitely coming on. Contracts, on the other hand, 735. I mean, we came in good. We came in good for September. We actually came in a little bit above where we're supposed to. I know it doesn't feel like it. I think it doesn't feel like it because, I know, because the climate's still really challenging out there. And the last few months have been, not exciting. But 735 is our monthly number. That is supposed to be 911. Okay, is what that's just the average. I know that's not a good, but 911 is what the average is for October. This should go higher.
Yeah, and again, this one's back half loaded, so you'll start seeing a tick up, but I'm gonna touch wood, salt over the shoulder, everything that I can do to get good luck there. But usually it starts ramping up toward late October. But so we hopefully have some runway left before we can get up and above that number.
Yeah, and that's this was last year right over here. That was what we did. That's what the curve looks like last year from this until about early to mid-November. That should continue, okay? And we'll keep an eye on it. Eyes on.
Yeah.
Okay.
Yeah, usually you have Labor Day, then you have the Jewish holidays, and usually you get that everything kind of starts sort of after that. It's really like that early October timeframe when you start saying like, oh, okay, we're now in the season, and here we are. It's early October, so I'm hoping we are in the season.
Yeah, well, I think we are. Got a good question here. Any thoughts about the L-1B visa changes? I have clients that are holding off purchasing for now. I don't know. I'm not hearing many things. I'm hoping the audience of agents that are listening today, maybe you could chat or comment and answer that topic in there. John, do you have any thoughts on this?
Well, the only thoughts I have are anecdotal, and that's, back in the day when you and I were representing buyers, we did represent some foreign international folks, none of which were H-1B people. They were all coming over here for investment reasons. They wanted to, have an investment property here. So I can't really necessarily speak to the actual people who are on visas coming here, but I would imagine if you had planned on buying an apartment in the city on a visa and now you have to pay $100,000 for a visa, it may cut into that. But a lot of times the companies pay for it. So long story short, we're just throwing more uncertainty into the mix when it comes to that. But hopefully that's only a minor subset of the buyer pool that's being affected by this.
Yeah. If you know anything about this whole topic, put it in the comments over there. But it's an interesting topic. I wonder if at some point we'll get an expert on this topic, bring him in for one of those Tuesday workshops that we do and have a conversation on it. Okay. And we'll talk.
And hats off to Karen, who always asks these really great questions. So thank you, Karen. I do appreciate it.
Turn your eyes to the bottom of this chart one more time, guys. You can see where we are at now. So I would expect this to continue until early to mid-November. Plan accordingly. If you are looking for price reductions, okay, get them, give yourself some time for the market to react to that reduction, still get that season. So you're in price cut time for the next couple of weeks.
Well, let me just follow that up. So I have to do let me just do my shameless plug for UrbanDigs Advisor, and that is our pricing report.
Too soon.
This is a good time for it. People are talking about it. We do a deep dive on your listing. It's a whole thing. Obviously, it's better before you list, but we can come in after it, and we're really good at getting price reductions when they're needed. I will, if you go to the YouTube link, I'll have my calendar thing. I can show you how it works. Hit me up. I'm show you how it works. We're really proud of it. It's really cool. Back to the show.
Yeah, very good. Thank you. Thank you very much, John. Yes, we are getting agents at price cuts. We do like to do that. Excellent question here again. Any insight as to the election? It seems that many people are scared, either considering selling, escaping the wealth tax, waiting to see if prices will drop due to the rush out of New York City. So this is the thing, right, guys? This is the big a concern that's kind of hanging over. I'll just tell you this. If you go to my dashboard over here, Thursday, October 16th, 1:00, we're going to be talking with Teresa Stevenson, Jared Anton, and Jason Haber about this exact thing. We're going to spend an hour on it. I don't want to hijack Macro Monday, but the way I think about this whole thing is uncertainty, right? It's uncertainty. When uncertainty goes up, buyers tend to just pause or not be as aggressive or wait it out. It's too soon to tell right now whether or not it's actually having an effect, because October is when the deals come in. And quite frankly, last month we did more deals than we usually do, which was an improvement. It was actually an improvement. It was a small one, but it was an improvement, right? So we'll see what happens with that whole thing. As you get closer to the election, uncertainty should peak out. And then after the election, uncertainty should go down. Decisions start to get made.
I concur. And I actually had this conversation with Asian this morning. And look, we have seen Manhattan and New York City in history has seen a lot of interesting characters come through and sit in Gracie Mansion. So where this falls in your own spectrum is one thing, but how this affects the buy side, it remains to be seen. But hopefully we're in the season. So hopefully we'll get some seasonal activity shortly. Yeah,
we'll know more of the next 3-4 weeks. And come on October 16th. That's going to be a very important session. We'll talk this all out. Guys, let's go to credit spreads. We are not going to spend a lot of time on credit spreads. We look at this as a warning sign, canary in the coal mine. If this goes up, there's a warning sign. If this goes down, risk on. Let's go. Stocks all-time highs. People scratch their head, wonder why. Search for yield, guys. Everyone's searching for yield in the stock markets where they're getting their yield right now. My light keeps going off and on. That's going on there. But I don't see any problems here, John, in credit spread land. So,
well, you know me. So I'm looking for problems in credit spread land. And while I don't see any big problems, I don't see any clogs in the pipe, so to speak, I do see that trend line is sort of kind of flattening out. We're not really in as clear of a downtrend as we were.
You're crazy.
Yeah. I'm just saying. I wouldn't be surprised to see this tick slightly higher. I wouldn't be surprised to see some of the markets start cooling off a little bit, just a little bit risk off, but not a lot.
No,
it's like, it's going to the barber after a couple of weeks. You just want to clean up. You don't want to.
I don't know what that's like, John. Sorry about of course, you had to use that comment, right?
I didn't mean to trigger you
there. This is sunny skies. In credit spreads, it is sunny skies. You know what? Maybe there's a little tiny cloud over there, all the way in the corner. but there's no clouds in credit spread land from my point of
Well,
view.
let me ask you, if you go out for a picnic and you see a cloud over there, do you take an umbrella? That's my point.
No.
I'm just packing the umbrella.
Bring on the rain. I like the
I got to carry it. Yeah.
No problems in credit spread land as far as I can see. Otherwise, this would be going up a lot more. Okay. Whether or not it's going to happen in the future, who the hell knows? So we'll keep an eye on that. Risk on. Don't be surprised to see stocks continue to go higher. That's what that means. Pivot. Rates, Johnny. Rates. 2 cuts.
2 cuts.
2 cuts, guys. And this is going up in 94%. 94%, 83%. It's going up. That means rates are going down.
Yeah, and it's going to be
Confidence
interesting because I think there's a Fed meeting this week, but they're not going to have the job. Well, I guess there's supposed to be jobless claims numbers this week, which are not going to happen because the government's on a semi-self-imposed vacation at the moment. Yeah, vacation, so we're not going to get those numbers. So there's going to be jawboning, but it's a new Fed governor, so we have a chance to understand what that governor's talking about. So you get you're going to get some maybe some more qualitative data out of the Fed versus quantitative thoughts. So it's going to be interesting to see which way they're leaning. But yeah, you're right. And again, we're at that point where once you get into, what is that, July next year, the market is just totally split. They don't know which way it's going to go. And they're just,
even here, even there's like, who knows territory. If I'm reading this table correctly, and I'd like to think I am, guys, we are here, right over here, right now. That's where we are now. The next meeting is October 29th. That is a 25 basis point, quarter point cut. All of these moves are quarter point. 94.6% chance that the market's expecting that move. So, I mean, I don't see the Fed pissing off the markets right now. So I think that's priced in. Okay.
Yeah, I think so too. But I think what you're talking about when you talk about the concept of, so let me just pop this up because there's a really interesting question about that.
Sure.
Join us late. Sorry, guys, with your audience. I want to earn. Oh, come on. That's not it. The concept of price. What
did you do? I got it.
I don't know.
Hold on. Got it? Right. I'm gonna take it. John, you sit this one out. You go on vacation. Joining this late. Sorry, guys. I want to discuss the visibility, for lack of a better term, regarding the concept of priced in. We are seeing an entire different point difference within the next 10 months. So the cuts haven't happened yet, Bianca. It hasn't happened. What you're looking at here with these percentages is the market's expectations of the future move the Fed will do on these dates. You see these dates on the left here, right? Those are decision dates. It's like betting. It's like the poly market. It's like they're betting on something. And as they get more and more confident, these numbers go up, and now the markets are expecting it. Mortgage rates already moved down.
Right. First of all, that was Roberto. So I said, hi, Roberto, in the chat.
You got to change your handle there, Roberto.
You keep tricking us, Roberto. But yes, what's interesting to me, and I think we have a chart on the yield curve at some point, because what's happening here is really interesting. And when you look at where the yield,
let's take a look.
Do you have the yield curve chart?
Yeah.
So the yield curve is basically where the yield is for treasuries over a period of time, right? So the left-hand side is the really short-term, overnight kind of things. And you go to the far right, that's the 30-year yield, right? Typically, what you want to see is lower numbers on the left, higher numbers on the right. And that makes sense because if you're going to loan the government money for 30 years, you probably want a little something more for the effort, right?
Yeah.
When you look at it right now, right, clearly the front end of that yield curve, right, the overnight, reverse repo, whatever you want to call it, that number is lower than where it was last year, somewhat significantly. But you look at that middle end of the curve, we're still inverted. What does that mean? Well, first of all, look at the 10-year. 10-year is actually up versus last year. 10 years what mortgages go off of. So we're seeing a little bit of rise there, but that middle of the curve, the so-called belly of the curve, is still lower than the front end. Why? And that's the concept of priced in. So the middle curve is pricing in more Fed rates to come. And so they're basically buying treasuries now to lock in these rates because they expect lower rates in the future, right? That's that concept of priced in. And that's why we're kind of getting some weird movement between the middle end of the curve and the front of the curve. So when the front end of this curve is down, we're seeing mortgage rates go up when the Fed cuts.
Yeah, and here's the mortgage rates actually pricing in those moves. Take a look at it, guys. The dark blue is conforming. The light blue is jumbo. So we probably look at the light blue for our market, jumbo mortgage rates, and it's been going down for months. The Fed only made one Fed rate cut move. but it's been going down for months. That is exactly the market's pricing in these things. So here you got it. And we get to watch it in real time. And again, if you're new to this, we do this every Monday. The idea is repetition, and you might learn something after a month or two, like, oh my God, I understand this thing, right? And that's the goal of this whole thing. Here's what you need to know. Here's what you need to know, guys. Okay, this is when you're talking to someone, a Wall Street guy, you'll impress them, okay? When I look at the Fed fund futures, that's what this is. When I look at the Fed fund futures of expected rate moves, okay, I see a 94.6% chance of a quarter point cut in October and an 83% chance of another quarter point cut in December. 2 cuts this year. That's already priced in. After that, 43%, 33%, it's forget about it. Don't even talk about it. It's too far in the future. It's too low confidence. I don't know what they're going to do. Say that. I don't know what they're going to do. I only like those 2 cuts because they're high confidence.
Yeah.
Say that.
I like that.
You'll impress them.
That's good.
Yeah, you'll impress
the other
them.
thing we like to watch here is the expectations, right? So obviously that blue number is that blue shaded box is the weight of where the market expects it. But when you start seeing those white boxes on the left or those yellow boxes on the right start moving, and you start seeing more of those numbers increasing, you kind of get a sense of what the market expectations, how they're shifting. So even though you might not necessarily see the cut indication moving, you can get a sense of which way the market's kind of leaning into the Fed. So that's another thing to look at as well, just to add some confusion to the mix.
Well, let's just clarify out, guys. Rates are going down. That's all you need to know is rates are going down as the market's expecting more cuts, kind of a thing. And this is the move. And I got to be honest with you, rates are in a good place right now, guys. Roberto, again, all makes sense. But how much of the entire 1% is actually priced in the next 2 cuts, the next 3? I would say the next 2. I would say the next 2 cuts are priced in. After that, the markets aren't so sure because the markets think like we're thinking, like now it's just too far out and the confidence is too low. So they're okay. Great mortgage rate time for buyers in the fall season. Couldn't have come at a better time. These are like the best rates we're seeing in a year.
Yeah. And this is actually, so I'm just going to pitch this out to the crowd. One of the things we thought about doing is bringing on mortgage professionals onto the show from time to time to have them, number one, talk about what it is they're seeing in the mortgage market. Number two, talk about, obviously they'll probably talk about their book and talk about what kind of specials they can offer. But the idea is, I'm more curious, besides the headline mortgage rate, I'm also curious, especially when it comes to the jumbo rate, what banks are willing to do to get people on, because these loans are generally held to maturity on the bank's balance sheet. They want to make money off of them. So they're trying to entice people to get them. So I'm curious what kind of spread they have between where rates are and what they're willing to do. So if that's something that you think would be interesting, please let us know and we'll work on it.
Okay. Meanwhile, what's driving all of this? Okay, guys, what's driving all of this of whether or not we get 2 cuts or 3 cuts or 1 cut, no cuts, is basically 2 things, right? It's the economy and it's inflation. Okay. And the ISM, you're looking at the ISM right now, which is the Institute for Supply Management, which is a manufacturing side view of the economy, right? And it's looking at prices paid, which is that white line from these people. And then they're looking at the employment, which is the red line. And as you can see, the prices are going up and the red's going down. We don't know if this is going to filter through into CPI and all those other things because there's so many forces at play. But if you want, in a nutshell, why the Fed can't just keep cutting rates over and over and over and over again, it's because there's competing things, right? You got the sticky inflation a little bit, unknown with tariffs. I'll give you that. We still don't know. And the economy has a little bit of cracks in it. And that's why.
No, you're exactly right. And we've talked about this before, how the Fed is really between a rock and a hard place often when it comes to finding the gap or finding the line between supporting the economy, the job market, and fighting inflation. And as these lines diverge, the harder that becomes. And of course, if they're meeting without that jobs data, it's just going to be more about ideas than about data. So we have to see what comes out of that. So it's going to be an interesting week for that.
Yeah, a lot of data coming in, 2 cuts priced in. I don't know. I feel like we might just say this might be what it is, kind of a thing. It's possible we get 2 cuts and then we kind of stop there. It'll be very interesting. See how this all plays out. All right, get rid of the macro economy stuff. Move into a little bit of national housing, guys. I like to throw 1 or 2 of these national housing slides in here. I usually look at Resi Club. I look at Realtor. I look at Zillow. I look at a bunch of these stuff. We're in Manhattan, guys. We're in Manhattan. I know we're under our own little bubble, but this is Macro Monday after all. And again, I'm trying to give you information in case you have arguments with investors. Why should I consider the Northeast? Why consider Manhattan? The regional housing divide. August for sale inventory in much of the South and West approached or exceeded levels in August 2019. This is inventory today. Well, August it was taken versus pre-pandemic. And if you look at us in the Northeast, look at that blue. We're just down 30, 40%. We're just structurally so different. So if there is a bubble out there, it's probably not housing. And if it is housing, it's going to be only certain parts of the market, not the Northeast.
Well, so August 2019 is a really interesting time frame. And you think about where the Manhattan and the Brooklyn markets were in 2019. Brooklyn obviously was a totally different beast back then, but let's focus on Manhattan at the time being. Manhattan had crested 2015, 16, 17 were fantastic years. And then we just had year after year after year of just progressively down sales. And so we were sort of sitting in that bucket of August 2019. It was kind of like wasn't a lot of supply coming on. Certainly wasn't a lot of demand. But by the end of
rent regulations, mansion tax,
all this stuff was just hitting us. Remember late 2019, early 2020, we actually did one of our things we put on the site. We were talking about green shoots. We're starting to see some movements here that suggested like the market's coming back. And so it's interesting that time frame is interesting. I hope we're going to start seeing that soon here again, more green shoots, but maybe a little too early this season to tell.
Yeah, I feel like we're still stuck in it. I feel like we got glimpses. We got glimpses in it in March kind of thing. Very, very early April, we got a glimpse of it. We got a glimpse of it after the election last year. The market was good for a little while, but we haven't quite pulled out of it in terms of us. Manhattan itself is just doing very, very, very different things than the Northeast region of the housing market nationally. It's just completely the opposite, honestly. Yeah. So whatever is going on in our market is going to be very, 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 very different. Okay. Look at this. Like I didn't realize. Sometimes I forget about this, but owners' equity in real estate as a percentage of household real estate. It's just. I mean, it's look at it where it came from in the Great Financial Crisis.
Yeah. I like this chart because it suggests that. Well, to me, this is a bullish chart. And I think you and I were talking
very
about
bullish
this before the show. To me, this is a very bullish chart because it suggests that when a recovery comes, there's always going to be a recovery. We don't know when it is. We don't know what it's going to look like. We don't know how long it's going to last. But generally speaking, there usually is one. And I'm, again, salt over the shoulder, touch wood, everything you can do for good luck. But this suggests that this has a more sustainable nature to it because it's one built on equity rather than leverage. And I think that this is the kind of thing that could spill through into hopefully the broader economy is using, housing wealth as a source of good, for lack of a better word, for the nation's economy versus housing wealth built off of, multiple ninja loans and all that kind of stuff that propelled us in the early days of the Great Recession. So the Great Recession days.
Yeah, I agree. And again, this is just another thing that tells me, because I have these talks all the time. I mean, everyone has this pre-convailing notion that there is a bubble out there that is going to pop. There is this feeling that things don't make sense. Everything's overinflated. There's a bubble out there. It's going to bring housing down. It's going to bring and we're trying to say, it's like, I don't really see it in certain areas. It's just like stock market keeps going up, but you look at credit spreads. So why wouldn't stocks go up? Like, why wouldn't there be a search for yield? Rick Ashenbarb, the prevailing opinion from Bank of America experts is that mortgage interest rates will remain pretty much where they currently are unless unemployment rate weakens significantly. And I would kind of agree with that. But you got good levels right now. We're low.
Yeah. And I just want to chime back in on this chart. And one of the conversations, so we did this advisor program, I'm shamelessly plugging it again. But one of the conversations we've had with a lot of agents is for sellers who bought their place 15, 16, 17. And they're coming on the market now. It wasn't necessarily new dev, maybe it's a post
even 15,
even 15. And they're asking more than they paid. And some of these people are struggling with the idea that like, oh gosh, I'm going to break even at best, or maybe lose a little bit. And I think that's what this chart is echoing. So you definitely see this huge number go up, the spike up. But at the same time, you think about Manhattan hasn't really seen that growth of equity over time for a lot of people there, but they haven't lost it. And I think that says something about the market that we're sort of almost, and I think this goes back to one of the conversations we had even a year ago, or was it a year ago, maybe in the spring, about what that recovery might look like. And it might be a next leg up for Manhattan as that equity finally takes hold and grows, but not financial advice.
Yeah, never. I just want to put myself on record for saying, do you remember in the .com area? I want to go back to the .com era for a second. It was, the fiber optics, all the fiber optic plays, and they were laying all the cable and all that kind of stuff out there for the internet to get more bandwidth back then. I mean, you couldn't do video over AOL, it just didn't work. I feel like today that preconceived idea of a bubble that everyone's talking about is just really in a certain sector of the market that's probably related to AI or some derivative of AI, because the CapEx spending, the amount of money that these companies, top 10, 15 companies are spending in this area is just insane. And it reminds me of, Cisco and Sun Microsystems and all those guys back in the .com, JDS Uniphase, doing the same thing with fiber optics and servers and all that stuff. So I don't know, but look at this. You can see venture capital in AI. The blue is AI. The other stuff is all the other sectors. It's just not getting the look.
Yeah. No, look, I'm all in favor of it. I think AI can be a transformational technology. My only worry is that, again, like the internet deals back in the day, you're betting money. You're essentially placing money in companies on the idea of growth. And that question is, can the revenue that these companies eventually make sustain the growth that you expect? And in many cases, that answer is going to be no. So the question is this another too big to fail thing, or are we going to be able to sort of deflate some of these expectations, or rather inflate them as the revenue numbers come true? And I think that's a broader question for equity market investors at this point. But right now, there's just pedal to the metal.
Yeah, it totally agree with that. And let's cycle back to Manhattan. Made it. Cycle back to Manhattan and Brooklyn. Manhattan real estate. We talked about this on Friday. Manhattan activity through September. John, you looked at it, supply and demand year to date. New listing activity is supply. Contract signed is demand. And as you can see from this chart, it looks like supply is up there. It's kind of in the top third of it, right? And demand is in like the mid sector kind of thing.
Yeah.
So it looks like there's more supply than demand.
Well, in terms of the rankings, yes, there's been more supply than demand, and we can show Brooklyn in a second. But when you kind of squish these all together, you can get the sense that supply is a much steadier number than demand. I mean, we've had some really busy years, we've had some really quiet years, and supply is a little bit more steady, I would say. So to have more supply at this point is interesting. It's not overhang levels just yet, but I would like to see that demand number start making its way up a little higher.
There's Brooklyn.
Yeah.
There's Brooklyn. I guess it's kind of the same thing, but we don't have as many years of data because we just started in Brooklyn in 2020. So we kind of don't have all that information, but same concept is supply is a little bit higher than demand on the scale.
Right. But you can see that, again, I mean,
much tighter situation.
The thing with Brooklyn is you have two separate markets. You have the 2021, 2022 market, and then you got everything else. And those markets were just bonkers. And then we come back to the non-bonkers markets, and you're seeing a little bit more supply. Supply is a little bit higher than it was the last few years. Demand is middle of the road. So if there's one thing that Brooklyn can do, it can turn on the afterburner, and we're just waiting for that to happen again. But right now, it's just been sitting on the runway for a while. So see how that goes. Look at that plane metaphor all the way through. I'm impressed with myself.
Way to go, Johnny. All right, guys. And we're back to charts. And John, you had this one last idea before we sign you off for today. Of course, you can go if you have to go do your things. But I wanted to show you one more thing. And I wanted to show you guys that you could do this on UrbanDigs yourself in case you ever want to. But John, you brought up net inventory trends. I'll just explain what this chart is really quick. And then you could explain the relevance that you saw. So let's just take the last example in September. Okay, guys. When you think about supply, okay, 6,800 units on the market trying to sell right now, supply, right? There's a lot of forces moving, right? There are things coming off and there's things coming on. You got new listings coming on, but then you got stuff that's on that's going into contract and stuff that's on going off market and expired. So stuff going off, stuff coming in. This is telling you the net inventory change, whether or not there is a net positive of supply or a net negative of supply, meaning there's more stuff going off than coming on. And you brought up September, John. So what do you see here?
Well, you can actually go to max, and September. This is the highest in terms of those net inventory trends. This is the highest build in September we've seen since 2020, and I think maybe 2018 was a little bit higher. But why is this interesting? Why so many bars, John? I frankly I don't know. But I'll tell you what, this is an interesting way to think about. It's an interesting way to think about competition. If you've got a seller, they're on the market. This is an interesting way to think about. I mean, obviously, supply is one way of looking at competition, right? What else is on the market? But this is just another way of saying, hey, listen, when we look about what's coming on versus what's coming off, we have a build, and we have the most build we've seen in the last 5 years. So it's another way of talking about competition to kind of get through to a seller that, maybe the market expectations that you've got in mind for this unit are not necessarily on par with what you're thinking for price.
Right. And the way I look at this is I always like to go back to last year and then look at what lies ahead. Right. So I could clearly see that the wave of inventory has hit, and I'm not saying that there's stuff not coming on, but from a supply perspective, this is kind of when it starts to peak out almost soon and go negative for the off season. So on the flip side, you have that element, but you're in it. Like you said, John, you're in it right now. That wave just came on, and you have to deal with that competition until the market absorbs it. So interesting to look at that. You could also do this for Brooklyn. I don't want to leave Brooklyn out, but you could do these exercises for Brooklyn. You can do it for Manhattan. You could do for anything. Much different scenario in Brooklyn. It's up, not as much as it was last year, but a tighter market in Brooklyn.
Yeah, and that's one of the things. This is why Brooklyn is a really interesting market, is because, I mean, just the lack in general of green bars, because inventory for the longest time was absorbed as soon as it hit the market in Brooklyn. And that's why you see when you go to like median discount for Brooklyn, it's negative because people were paying over the ask simply to get their hands on something. Those days are over, at least for the time being. But again, some of these green bars have started to peak up, but they're nowhere near as tall as they have been in Manhattan. But still interesting to see how Brooklyn has shifted a little bit. And let's see how the fall holds out.
Yeah, we'll report on it every week for you guys. All right, we've reached the end. Thank you guys. Thank you guys for the questions. Thank you to John Walkup. Again, tomorrow, guys, to go over the calendar, we'll be talking about comps, going deep in comps. If you're interested in appraisal, comps, all that kind of stuff, great. Next, are we not on for Macro Monday next week? Oh, it's Columbus Day.
It's
right?
Yes.
Okay, so we're off Macro Monday next week. But next week, we got the Phil roundtable. We always love Phil. That's a great thing to go join in at 11 o'clock. And then we got the election effect. All right, the election effect, guys. We're going to be talking about the mayoral election. It's going to be a good one. Bring all your questions. It's going to get hot. It's going to get steamy. It's going to get kind of a little crazy. We'll throw some chairs around here. Keep it down, Jerry Springer style. But we're going to keep it real. And we'll talk about everything you need to know and how to handle all the conversations you might be having with buyers and sellers in terms of the election. Okay? Very important. Thank you, John Walkup. I'm Noah Rosenblatt. We're both with UrbanDigs. It's been Macro Monday. Catch you next time, guys.
Thanks, everybody.